Hey, how's it going, everybody, and welcome back to Income Views. On this channel, we talk so much about SCHD, so remember to leave a like and also subscribe. We're getting right into it. There are really great things about SCHD, but there are also risks as well, so it's crucial that you watch this video for all of that information. The concentrated risk for SCHD could be that, there is a, large focus on U.S. dividend paying stocks and heavyweights like industrials, financials, consumer staples, and healthcare. So if one sector like financials tanks, then SCHD feels a little bit less diversified than other ETFs out there. There is market risk as well when we talk about SCHD. And even though it's targeting stable companies, then SCHD still follows the overall stock market as well. So there is a potential that if there is an exponential crash, then further than what we've even seen this year alone, then you could see SCHD drop even more than it already has. So in a crash and a recession, its value will drop, and maybe not as hard as some other tech-heavy funds, but it's not immune. I will have to say, though, in defense of SCHD, if you take a look at 2022, then you'll see that when we had a technical recession, and I repeat, technical recession in 2022, and I'll go to my grave knowing that 2022 was a recession. In any case, SCHD, and I'm sure a lot of people know what I'm talking about when certain people denied that it was a recession, and even though it was, and I'm not going to get into all of that, but anyway, SCHD in 2022, when there was that type of economic downturn, then you saw that SCHD held its own, and it wasn't a phenomenal type of growth, but it was a heck of a lot better than other companies that were on the stock market. It essentially like an Amazon. Amazon got crushed in 2022. Just that alone, just take a look at SCHD compared to Amazon, and I want you to tell me what was a better investment back in 2022. All right, was it Amazon or SCHD? Crazy. But again, there are risks, so let's get back to it. Dividend cut risk. SCHD holds companies with a strong dividend history, but dividends aren't guaranteed. In downturns like 2020, some reliable companies cut or suspend dividends, and SCHD's income could drop there. However, again, in defense of SCHD, there is a 4% or 4.1% dividend, I believe, or 4.8%. They just raised this, which is very exponential here. So the SEC 30-day as of 4/10/2025 is 4.08, and that again is coming from Schwab Asset Management. That's my source there. Turnover and selection bias. SCHD rebalances annually, and they just did this year. So you have to be very careful that if you don't like certain companies that SCHD is investing in or invested in as of right now, then it may not be for you, and you may want to cut your shares there. But SCHD does a nice job at this, in my opinion, and they have a great track record to show for it. But at the same time, it could be something that's just not for you. It may not be something that you want to invest in. Interest rate sensitivity. When rates rise, dividend stocks can look less attractive. That's a really good point. So compared to safer bonds as well, so SCHD's price can lag in high interest rate environments as investors shift to fixed income. We saw this last year. Last year is a great example where SCHD may not have been the most attractive because it wasn't guaranteed income, or at least for its growth. If you were at risk, if you thought there was a risk of SCHD dropping, then, or at least a high risk last year, then you would not have invested in SCHD. You probably would have went for like a CD or something like that. And I mean, that could potentially be something that you may want to think about before investing in SCHD. Thank you so much for watching, and I'll see you in the next one.